Imagine waking up to find out that $1 trillion, yes, $1 trillion, has just vanished from the American economy. Money that once flowed from Beijing into Hollywood studios, Wall Street banks, and Silicon Valley startups, suddenly gone. That's not a movie script. It's what just happened. Beijing has slammed the door shut on U.S. investment. No leaks, no whispers, no slow wind down. The pipeline snapped, and the shockwaves are now racing through corporate America. CEOs are scrambling, markets are jittering, and ordinary people, from workers on the assembly line to families counting on their 401ks, could soon feel the pain. But here's the kicker. This wasn't an emotional reaction. It was a strategic strike, a carefully calculated maneuver in a conflict that has escalated from trade disputes to tech rivalries, and now to something far more dangerous, capital warfare. And if you think this is just another round in the ongoing spat between Washington and Beijing, think again. What China just did may be the opening move in a financial siege designed to bleed America quietly, methodically, and relentlessly. So the big question tonight: why did Beijing suddenly block outbound investments into U.S. companies? What's the long game here? And more importantly, what does it mean for you, your job, your retirement, and the prices you'll pay at the store this year? Stay tuned, because we're about to break this down in plain English. And trust me, the picture is even more alarming than the headlines. China's Ministry of Commerce quietly updated its outbound investment protocols, classifying all so-called non-essential capital flows to hostile jurisdictions as suspended. The United States was right there at the top of the list. Regulatory filings confirm that the State Administration of Foreign Exchange, or SAFE, issued an internal directive halting approvals for U.S. deals. Officially, the reasoning was geopolitical risk and asset security concerns. Unofficially, it's a financial weapon. And the effect? Overnight, Beijing's long-shrinking pipeline into U.S. companies has been cut to zero. This didn't come out of nowhere. Since 2018, Chinese investment into the United States has collapsed by over 90%. It fell from $46 billion down to barely $2 billion last year. Analysts at Rhodium Group have tracked the steady decline, and this latest freeze slams the figure to the floor. Think about that. The world's second-largest economy has gone from being a major investor in America to pulling the plug entirely. But here's the twist. What's more important than what China just stopped is where that money is now going instead. If you think this is just a freeze, you're missing the bigger play. This looks like the opening act of a siege. Beijing has been peeling away its economic dependence on the U.S. step by step. In 2024, China sold off $14 billion in U.S. treasuries, the biggest annual dump since 2016. That brought its total holdings down to about $775 billion. At the same time, state banks began quietly limiting dollar transactions with U.S. financial institutions under new rules from the People's Bank of China. In plain language, Beijing is unplugging itself from the American system. Washington knows it. U.S. Commerce Secretary Gina Raimondo warned in January that China is restructuring its financial exposure in ways that reduce America's leverage dramatically. And here's the uncomfortable truth. Washington's old playbook of tariffs, export bans, and sanctions is proving far too slow. Worse, those same sanctions are backfiring, pushing China closer to Riyadh, Moscow, and even European capitals where businesses are already lobbying to bypass U.S. restrictions. The leverage gap isn't just growing, it might already be irreversible. Foreign direct investment into the U.S. dropped by 22% in 2024, and projections for 2025 show another 19% decline. And this isn't just about China. Norway's sovereign wealth fund dumped over $7 billion in U.S. tech stocks. Japan's massive pension fund cut its exposure to U.S. commercial real estate by 30%. Why? Because Moody's just downgraded several American regional banks. With $4.1 trillion in corporate debt maturing by 2026 and fewer foreign buyers willing to roll it over, U.S. companies are being forced to borrow at home at much higher costs. And this is where the squeeze really starts to show. With equity investment drying up and banks reluctant to lend, companies are flooding the junk bond market. In 2024 alone, over $430 billion in high-yield debt was issued, a staggering 38% jump from the year before. Yields on that debt are now pushing 10%, nearly double what they were just 2 years ago. Take Hartwell Tech, a mid-sized Boston manufacturer. They were counting on a $180 million Chinese equity round to expand. That deal evaporated overnight when the freeze hit. Desperate, the company turned to Apollo Global for a bridge loan at 11% interest, secured against their patents and their headquarters building. Fitch Ratings is now warning that 1 in 5 American mid-cap firms faces rollover risk within the next 18 months. Translation: survival mode is setting in, and it's brutal. Now remember, reshoring was supposed to shield America from exactly this. Trump's 2025 executive order expanded tax credits to bring supply chains back home. But here's the reality: the money isn't there. The National Association of Manufacturers says over 60% of firms planning to expand in the U.S. now face serious funding gaps. Projects that were announced with fanfare in 2023, like the $8 billion battery plant in Michigan or the $3 billion robotics hub in Nevada, are either delayed or canceled. Even Intel's $20 billion Ohio semiconductor project has paused Phase 2 because funding isn't lining up. Economists like Eswar Prasad are blunt. Without diversified capital, these initiatives risk becoming symbolic instead of transformative. Localizing supply chains is expensive, and with fewer foreign partners, costs rise sharply. That cost eventually lands on consumers. Tariffs under Trump's new expansion now cover more than $500 billion worth of Chinese goods, up from $370 billion just a few years ago. Average tariff rates are 22%. That's hitting everything from electronics to auto parts. According to official data, appliance prices alone jumped almost 17% year over year in the first quarter of 2025. Walmart and Target have issued profit warnings for back-to-back quarters, saying tariffs are squeezing them hard. The National Retail Federation calculates that the average U.S. household will pay nearly $2,000 more this year for the same goods. Corporate profits are already thinning out. In the last quarter of 2024, S&P 500 earnings growth slowed to just 1.2%, down from 4.5% the previous quarter. Companies are being forced into an impossible choice: absorb the cost themselves or pass it on to consumers. With inflation still over 3.5% and wages flat, passing it on could crush demand and take balance sheets down in the process. And if you think that's bad, consider what's coming next. The Economic Policy Uncertainty Index, which tracks how chaotic and unpredictable policies feel to businesses, is at its highest level in over a decade. Higher than during the 2020 lockdowns, higher than the 2008 financial crash. The Conference Board's CEO Confidence Index cratered to 37 in March. Nearly 70% of executives say the lack of clarity from Washington is their biggest barrier to making long-term plans. Bank of America analysts warn that capital formation, the very act of raising and deploying money, is stagnating. Not because it's too expensive, but because nobody knows what rules they'll be playing under next month. That confusion is driving investors away. In just 90 days, more than $120 billion exited U.S. equity ETFs. Think about that. Money is fleeing not to seek higher returns, but simply to escape the chaos. And allies are noticing. Germany's BASF has just doubled down with a $10 billion expansion in China. France signed a long-term LNG deal denominated in yuan. The European Chamber of Commerce in China reports European investment in Chinese industrial zones surged 19% in the first quarter alone. Even Saudi Arabia is moving away from U.S. treasuries, putting $27 billion into a joint AI fund with China and Singapore. As former IMF chief economist Kenneth Rogoff explained, U.S. soft power isn't collapsing, but its gravitational pull is fading. Allies aren't storming out in protest. They're hedging. They're diversifying. And Beijing isn't demanding loyalty. It's offering predictability. Here's the bigger game. Beijing's freeze isn't just defensive. It looks like phase one of a long-term strategy to redirect global capital flows. The China Securities Regulatory Commission is fast-tracking IPOs in Shanghai and Shenzhen with 38 new listings in just one quarter, a 52% increase. The Sovereign Wealth Fund is boosting ASEAN debt exposure. And most strategically, the digital yuan is slowly being integrated into cross-border settlement networks that don't touch the dollar at all. One HSBC analyst put it perfectly. It's not about replacing the dollar overnight. It's about giving the world enough alternatives so the dollar becomes just one option, not the default. And if America's credibility keeps shaking, the drain won't come with a bang. It'll come with a quiet, steady pull. By the time Wall Street notices, the money may already be gone. So here's the question. What happens if Beijing convinces even America's closest allies to stop settling trade in dollars? That's not just a trade war. That's a global system reset. Not through speeches, not through sanctions, through math. And math doesn't care about politics. This is why China's investment freeze matters. It's not just a regulatory adjustment. It's a signal, a warning shot, a hint of how Beijing plans to reshape the world economy on its own terms. And if that strategy keeps gaining momentum, Washington could wake up to find that the rules of the financial game aren't written in DC anymore. If you made it this far, you know this story is bigger than just headlines. It's about power, leverage, and the future of global finance. If you want to stay ahead of these shifts, hit that like button, subscribe, and turn on notifications. Because what's happening now isn't just history in the making, it's your future being rewritten. Thanks for watching, and I'll see you in the next one.